There's so much to learn about wealth management that it can seem overwhelming. In this episode, we're going to talk about the 3 main things that you might need to know in order to be able to work with somebody like me and understand the basics of what we're doing and why. So what we're going to talk about is, 3 things. I kind of tried to whittle the world out there, the wealth management world, the financial planning world, the investment world into 3 main concepts that people would need to understand if you're a corporation owner in order to understand 80% of what we're doing and why we're doing it.
Okay.
Oftentimes when it comes to making these type of decisions about not just who to work with, but what type of strategy to use and things like that, it can be very overwhelming. It can be even overwhelming for me, let alone, and I'm live and breathe this stuff. Mm-hmm. So it would be very overwhelming for the average person.
Yeah.
I often describe financial planning and investment management and things like that as that cog, which actually I bought a toy to illustrate this, and I
think everyone knows what you're. I think everyone knows what you're talking about. But yes, as soon as you said that, I was like, "Where did that thing go?"
Yeah, I bought it so I could use it and twiddle the toy. I don't know. I'll find it.
I think I know where it is.
But anyway, when you move one thing, it's like some gears. Everything else adjusts accordingly. Mm-hmm. So when it comes to the way that I approach financial planning, there are some gears that I have stuck so that they don't move. They're not going to move positions, and that allows me to move other areas around that.
Okay. Yep.
Right. So instead of
probably like the toy, most of the time there's ones that are stuck in place.
Yeah, that you're not going to move. Sorry. And those. So we're going to talk about some of those items.
So those are the 3
that not quite, but they help explain why my process is the way that it is. A lot of people, I think customization sounds good to a lot of people until you realize in this world how deep that rabbit hole goes if you truly, truly try to customize everything. So there are some key things that I do the same way, and they're kind of big pillars.
Okay.
So first concept that you need to understand is, sorry, did I mention who this is for?
Corporation owners?
Yeah. So you're at the point where you have a fair amount of complexity to your financial life. You're likely investing in non-registered and taxable accounts. You likely have a corporation, and your life's just a little bit more complicated than the average person. Okay. So, because the average person, you can kind of walk into anywhere, and the investment thesis doesn't really matter if it lines up with the financial planning and tax approach and things like that, because there's a lot of tax sheltered stuff that the government gives you in order to be able to navigate these waters pretty easily. Mm-hmm. As soon as you're now investing in non-registered accounts and things like that, suddenly it's a big switch that happens, that you go from this really simple approach to, okay, now I have to learn so much, or you think you have to learn so much because
things change.
Things change, right?
Yeah.
But it goes from a level 1 complexity to like a level 7 so quickly just by now investing non-registered. And it seems like such a small step, but that is a big change in how you now approach somebody's finances. So
this is only for corporation owners, or is this non-registered is complicated for everybody?
Non-registered is more complicated for everybody. Corporation owners, there's 2 tax codes to abide by, so it's exponentially more complicated because of that, right?
Yeah.
So first concept is 3 main types of investment income. Do you remember what those types are?
Investment income is not interest. Is that episode?
Yeah.
Is that referencing that episode? Okay, let me find it in my memory log. Dividends
is one, yeah.
And I can't remember the names.
Capital gains.
Oh, capital gains, yeah.
And then other income, so that includes interest.
Capital gains. I don't know why. That one I can never remember. I'm like, that's dividends or salary. That's because that's what I always link it. Yeah, that's what I always link it to. Yeah. Anyway, sorry.
So interest, what do you get interest from?
from the bank.
Okay, you get interest from fixed income. So things like GICs, bonds, anytime you're lending money to somebody else for a fixed return, it's going to be interest income. Okay. Then you have capital gains. When do you get a capital gain?
Sorry, what do you mean, when do you get a capital gain?
Yeah, what do you get capital gains from? What's a capital gain?
Like from your investments.
But why would you get a capital gain?
Because you've gained on your capital. That's literally, I'm like...
So it's when something increases in value.
Yeah, you've gained on you put the capital in, the capital has gained. That's your capital gain.
So when you sell something for more than you paid for it,
yes,
that is a capital gain.
We're saying the same thing.
No, we're not. Because that capital could gain from interest. That capital could gain from your...
So it's when you sell. When you sell, right.
Yes. That
just because your investments have grown, that's not the capital gain yet. Right? Until you sell it. Like if you go into your portfolio and you're like, would you call
kind of you don't realize the capital gain until it's sold. Or there's a disposition, but it's still a capital gain. It's just the difference between what something you paid for it and what it's worth today.
Right.
Okay. And then there's dividends, which is what?
Oh gosh.
Okay. Dividends is where you're where you own like a stock or you own a company and it's distributing some of its cash to shareholders.
Yeah.
Okay. So the three main different types. So to review quickly, so for interest income, we're going to just use the top marginal tax rate. So how much you would pay in the highest tax bracket. You'll be paying 47.5% of it to taxes.
Yikes.
If that money is in a corporation, you're paying 52.7% to taxes.
Wow.
For a capital gain, if you're personal non-registered account, so the most you'd pay personally, is 23.75%.
Okay, that's a big drop.
Big drop. And then in a corporation, 26.3%.
Mm-hmm. Okay, it's better than the personal.
Yeah. Well, no, 23% personal, 26% corporation. Dividends is 29.6% for both. Canadian dividends.
Okay.
Canadian dividends only. We're not going to touch on the other stuff. What about an RRSP? This is a slightly different concept, I guess.
Yeah, like what?
So with an RRSP, when you pull money out,
yeah,
you pay tax on the full amount.
Yeah.
So the marginal tax rate that you would pay doesn't matter what type of income it is.
Okay.
So you would want your most expensive type of income to be earned within RRSPs.
Okay.
So what would your most expensive type of income be?
Fixed income.
Correct. So you'd want your interest income to be earned inside of RRSPs. You would want any capital gains earning investments to be held personally and inside a corporation, and same with Canadian dividends. Foreign dividends is a different case. We're not going to get into that. Okay,
please don't
keep it. I'm trying to keep it simple for this one. Yeah. Okay, so that's the first thing that you have to understand. Different types of investments earn different types of income, and you can tell what type of income an investment is going to earn by the way that money is invested. So it's very seldom a surprise that the money is suddenly earning interest. It's like, no, of course it's going to be interest income. It's GICs. That's all they do is interest income.
Yeah.
So it is predictable. It is something that you can plan for and that you can plan around and control. Okay. So that's the first thing you have to understand. Second thing that you have to understand is that risk is, in my industry, is not the same as what people think about risk. A 100% fully diversified portfolio, what risk level do you think that is?
A 100% fully diversified.
Sorry, 100% equity, so stocks.
Yeah.
Fully diversified portfolio, what do you think it is? Like global index.
What would the risk level be?
Yeah.
I would say they'd probably put it at high risk.
You'd think. So it's medium.
Okay.
Right?
But I would say it's, I feel like the risk thing, that's why we did the risk episode however long ago. Because it's like, how do you just put a label on it?
Well, they needed to find some measure, so they use volatility, right? The ups and the downs.
It's just hard when it's like, this variance. Is medium risk. Like,
exactly.
It's weird.
So the way that I prefer to explain it or for somebody to understand it is that the more that can go wrong, the higher the risk. Is the way that you should think about it. So, for example, while a 100% fully diversified portfolio, globally diversified portfolio might be medium risk, a 100% natural resources fund in Canada, you're now looking at high, medium to high, right? Like you significantly jumped in
because
risk.
You've like narrowed it down a bit.
Yeah, exactly. So when you're looking at the type of risk to take, I challenge people not to think of it as percentages of, so the amount of fixed income compared to the amount of equity. Think about truly what could go wrong, especially what could go wrong in my time frame of investing. And you're kind of picking the lowest risk investments, and by lowest risk, the lowest risk of a bad outcome investments that you can across all time frames. And that means that fixed income gets more risky the longer you hold it.
Okay.
So you do not want to be holding fixed income for long time frames because fixed income is based very heavily on interest rates.
Yeah.
And I can tell you, there's very few people that can predict interest rates over a 30-year time frame. I have no idea. But we can predict the fact that humans will likely progress. We'll likely build stuff. We'll likely make new technologies over that same 30-year time frame. So if we're going to pick one, which one has a lower risk of a bad outcome? Okay, so that's the way that the lens that I try to encourage people to look at risk through.
Yeah, I love the pessimism. I feel like it's actually like I actually do. I say that in a jokey way, but like thinking like I feel like a lot of people catastrophize things in general instead of just focusing on what is the absolute worst case scenario here. And then focus on that. Okay, then you can make your decisions around.
It's because people don't know.
Don't know what the worst case is?
No, because when you think of like there's 15,000 odd different mutual funds and stuff, like it's very overwhelming because there's so many different options. So most people can't tell the difference between two. So when you can't tell the difference, you paint them all with the same brush, and you might have heard of a friend or something like that, or a coworker or whatever that lost a bunch of money investing, and you think, oh, investing, that means investing versus, okay, what were they actually doing? Right?
And what, like, did they just pull out at a bad time as well? Because
right.
I've heard a few people say stuff like that, and I know full well it was them who was the problem. So
it's like the markets are the markets. The markets going up and down are it is not a problem to solve. Yeah. It's a feature of the markets. That's how they work.
Yeah.
It's up to you then to choose to navigate that properly. Right. Yeah. It's like going on a river and complaining that there's rapids. It's like, well, that's the river. That's how it works.
Yeah.
Now you have to make sure you're prepared for that.
Yeah.
And when it comes to people and their ability to handle the ups and the downs of the market, I'd liken it to like the first time you ever drove like a car. The first time you get in the car, it is terrifying. It feels like everything is so big, the car's big, and the more you do it, the more comfortable you get. And then you go on the highway, and it's so fast. Everything's so fast. Cars are coming left, right, and center is what it feels like.
Yeah.
And then you do it for a while, and you realize, okay, this isn't actually as bad as what I think. And it's very similar with the markets, where the thought of your finances or the money that you've put there going up and down 2, 3, 4% a day, dropping 15% a week, coming back up 10, but like the thought of that is a lot scarier when you're new to it.
Yeah.
But it's really important, just like with driving, that you still take that step and get used to it.
Yeah.
And most people, where people screw up is trying to avoid those ups and downs and introducing new risks that are a lot scarier in order to avoid something that is just a feature.
Mm-hmm.
Does that make sense?
Yep, completely. I had a lot of thoughts running through my mind. Like, just the fact that a lot of people want to play it safe in that sense. Like, fixed income sounds safe, but it's, like you said, there's just different risks. Like, if you choose never to drive, or like you're never driving on the highway, it's not like you're eliminating every risk of driving, or you're not eliminating every risk that involves vehicles or whatever. You know what I mean? It's like...
But the pros of driving on the highway and being able to travel are a lot higher than the downsides, right?
Yeah.
Like,
and it's like you just prepare appropriately. And yeah,
you wear your seatbelt.
Yeah.
You make sure your car's in good repair.
We love a good metaphor. Sorry. I feel like we would just keep climbing on that. So let's keep going.
Yeah. Okay. And then the third one is investment philosophy. So I have a very strict investment philosophy of the data shows that low cost, globally diversified index funds and things like that are going to be the right way for the majority of people. And that's because the cost of missing out is significantly worse than the cost of going through the ups and the downs. Okay. When I'm planning everything else to do with the planning side, when I build my systems and processes, it is based on the predictability of the types of income, for instance, that a passive type investment will generate compared to an active manager. So you're like, what the heck are you talking about?
Yeah, I'm a little lost.
with a passive type investment philosophy, there is very little what we call turnover. So turnover is when a stock or an investment within an investment vehicle is bought and sold by the manager. So not by you doing it, but by the manager making that decision.
Yeah.
You still pay capital gains, though, on that manager buying or selling. Just because you didn't buy or sell the fund or the ETF or whatever doesn't mean that you don't now have capital gains, which makes it very unpredictable when it comes to investing. Because when you have that complication increase, there is something that we call tax drag, and that's how much tax are you paying to own this portfolio. The lower the tax, the better, because that means that there's more left inside of the investment to grow. Makes sense. But up until that point, it doesn't matter, because if you're investing inside of TFSAs, RRSPs, things like that, there is no tax drag. It's completely irrelevant if that active manager chooses to sell 90% of his portfolio and repurchase something. It's completely irrelevant. But as soon as you're in taxable accounts,
the non-registered ones,
if you have $1 million and the manager decides to sell 3/4 of it to buy new stuff, and there's 50% capital gains on it, suddenly you have a $120,000, $150,000 tax bill.
Wow.
For nothing, right?
Right.
So,
but not for nothing. Like if the active manager wants to, they're putting them into something else.
Yeah, they're buying a different company or whatever. Something
because they're like, oh, this is a good idea or whatever. But it's like something to consider.
Yeah, and when you don't have control, you're always at risk of something just being done to you, I guess. And when you combine the fact that you're not in control of the taxable dispositions and stuff, and you combine that with the fact that the vast majority of active managers underperform their benchmarks, it makes it very compelling to then use a strategy that is not going to underperform by the nature of the strategy, and one that you can then control the tax side so that you can optimize other things for sure, right? It's much better that if I can say, okay, I can earn an extra 1% basically by paying less tax every single year on my portfolio or my investments. And I know if I do this, it's as close to guaranteed as you can get, as in like, I'm not betting on what the markets are doing. I am just optimizing where the location is and things like that, just so it better conforms with the tax code, right? Like it's not, you're taking away the unknowns as much as possible.
Yeah.
Does that make sense?
I think so.
Yeah.
Yep, I think so.
So that's why when I'm reviewing these three things are very core to recommendations that I make.
Okay, so repeat the three, like in a recap quickly.
So different types of investments and different types of income, and it's predictable and you can plan around that.
Okay.
Risk is different. Don't look at high equity, meaning more risk. Think of it as, okay, what's the actual risk of a bad outcome, and plan accordingly. And then investment philosophy, low turnover, very predictable income from the investment.
Yeah.
Is a core pillar of everything else that I plan around.
Okay, that makes sense.
Yeah, because if I'm purchasing, let's say I choose, for example, I would pick Canadian equity inside of a corporate account. If suddenly that Canadian equity is creating a ton of tax drag, a ton of passive investment income, and now the corporation is having its capital gain, its small business deduction clawed back and things like that. So things that have a detrimental impact to a business. And you could have simply avoided that by holding a Canadian all equity fund that likely would have done just as well. Why would you take the risk?
It just sounds like more work later too, because then you're like scrambling to try to fix it.
Well, you can't fix it. It's done is done. Like,
yeah, but wouldn't you want to change it after you pay once? Or do you...
Well, the issue is you might be, maybe, right? But it's in a taxable account. So the consequences for changing could now be huge, right? So you want to pick something that you can stick with for the next 20, 30 years if you have to, right? Yeah. And that's why, again, that approach is so important. What if you're in let's say we pick an active manager and we pick Dynamic, I don't know, they're a mutual fund company, and then the management team changes and we no longer trust the management team. Mm-hmm. Or they decide to close down the fund. Or like, it's just so much out of your control that it's like, why are we taking this risk when we could earn?
And they're just people, right? It's just like random people. Like, I know that maybe that sounds
random people, but
I know that sounds way more simplified, but realistically, it's like I like this one with a bunch of random people doing. Yeah. It's so weird.
But they have very prestigious degrees from very prestigious schools.
I just feel like sometimes there's like what do they call it? A stereotype. I think I talked about this in another podcast too, of like the finance guy.
Yeah.
That's what I imagine those guys are doing. Sorry.
And girls.
You're right. You know what? You're right. But it's usually the guys in my head that are like sketchy and just being weird.
Sketchy? Okay.
I don't know. You know, like the stereotype of a finance guy?
Yeah. Isn't there a song about that?
So it's like, I know what you're talking about.
Like on a TikTok or something.
It's not the same.
It doesn't matter. I don't know. But yeah, those are the three concepts that will help you greatly understand what we're doing, why we're doing it for the most part. That will get you 70-80% of the way.
That makes a lot of sense.
Okay, that's it.
Cool. Easy.
Nice and easy episode.
Perfect.
Well, we'll see you guys in the next one.
Bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Tré Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.